So what does a rate cut mean? I'm gonna let you know right now. Yesterday, the Fed decreased the federal funds rate 25 bips. And a lot of people think that directly affects the mortgage. Well, it doesn't. But I will tell you what it does. The short-term rate is basically what you use for your credit cards, your car loans, and bank interest rates on your savings accounts. That's what your short-term rate is for, and that's what the Fed decreased. And the reason why the Fed did that is because the latest jobs reports that have been coming in, and they've been coming in kind of low, and the Fed has actually revised those job numbers, those job reports, lower and lower and lower. And what that's doing is decreasing the confidence in the performance of the economy. So the Fed, they came in and said, hey, we probably need to take some action now before things get too bad. So they decided to be conservative and decrease the rate by 25 bips. So what they're doing is they're trying to stimulate the economy just enough to keep those jobs from falling any further and sliding us into a recession. So what does that mean for financing? So it doesn't mean much for Fannie Mae, Freddie Mac, which is what we focus on. But what it does do is it helps those who are in bridge loans or trying to do bridge loans, and it makes the bridge loans better affordable. What that actually means is the gap on the interest rate, it goes down. So instead of having an 8-9% rate, it drops down to 8.75. Okay, not really that big of a deal, but it means a lot to those who are doing those deals with bridge loans. What that can mean for longer term loans like Freddie Mac and Fannie Mae is that if the Fed is illustrating no confidence, then the bond market, which is what those loans are based on, they're probably going to start to follow suit, and more people are going to put their money in bonds, which lowers that. And I don't want to confuse people, but if the market isn't confident things are going to be good, the interest rates go down. We'll just leave it at that. So property valuations, if we continue to see the 10-year treasury go down, cap rates are going to start to slide along with it. And when the cap rates go down, valuations go up. I'm not going to go into how all that works. But what this is ultimately going to do is increase the market liquidity, which means more buyers are going to be able to come to the market. Sellers, their valuations are going to match, and it's going to open things up. So the more those rates get cut, the more opportunities we're going to see in the market to transact. So what our strategy is, we're watching our portfolio, we're operating, we're keeping an eye on our market, we're localized. So we're paying attention to our boots on the ground so that our performance is good. When we're looking at new acquisitions, we're looking for opportunities. We're looking for cash flow. We're looking for undervalued properties. So that's what we're looking for, and we're super bullish on what's going to be happening in DFW. If you guys want to stay up to date on what we're doing at M Group Capital, follow us on LinkedIn right here or on M Group Capital's Facebook page right here.